Hi, everybody. Can y'all hear me okay? Doing good? Okay. So I've got 25 minutes to do a 40-minute talk. I'm going to try and get through it on 1.5x speed. If y'all miss something, just watch it later. Okay, so the name of this talk is How Does Satoshi Think of Bitcoin? And I'm going to just tell you the answer right at the top. It's because of monetary policy. 21 million isn't just a meme. It's not just a shelling point. It's maybe not even just good economics. I'm going to make the claim that it's an essential technical simplification that was required for Satoshi to extend the work of historical projects and actually conceive of Bitcoin. So let me try to motivate that a little bit. First of all, this is not even what I want to be talking about. What I wish I were talking about were a much larger story about Bitcoin as layers of markets and how we need to stop cargo culting the blockchain and instead focus in on what makes Bitcoin really successful, which is market incentives. But I can't talk about that. I found that in trying to write about this, I needed to do a lot of research and go back to some of the original work, the white paper, the references it contains, their references. And I found myself asking constantly this question, hey, before I can tell this story, I really need to know what was special about the beginning. What was so new about what Satoshi did? Because a lot of projects came before Satoshi. This slide's a bit messy, excuse me. There's a lot of stuff that happened before Satoshi, and it turns out notions like proof of work, the blockchain, cryptography for transactions and public key ownership, all these concepts existed. So what did Satoshi really do? How did they think of Bitcoin? What was the key insight? So the plan for the talk is I want to start by just talking about decentralized systems overall, like Bitcoin, convince you that they have to be markets, they can be nothing else. I want to talk about specifically a decentralized system that we would use to build money, and how would that market necessarily have to work. I then want to talk about historical attempts, everything from B-money to BitGold, etc., at trying to build that market, why they failed, and maybe what they got right. And then I want to convince you that it's really monetary policy that Satoshi brought to the table, and that's what allowed Satoshi to succeed where others failed. And if I have time, which I won't, I'll talk about how really the point of all of this is that understand that Bitcoin is a market indeed, but it's also a methodology. Like there's lessons in this talk, hopefully, that we can follow if we intend to build larger, more productive systems on top of Bitcoin to disrupt other human networks. Okay, so I'll start by just talking briefly about decentralized systems. This word is often misused. I'm going to try and define it for you in a very simple way. Decentralized to me means markets. Decentralized systems have to be market-driven. This is an idea I got from my good buddy Ryan. Check out our talk from 2 years ago. I forgot to promote that at the top. Decentralized systems have to be markets because no one is in charge of them. There's no central point of control. There's no main API server. There's not even anybody to really tell us the time. And in a system like that, how do we get it to observe rules? Adversarial behavior cannot be punished by a central actor, so we must rely upon local economic incentives or disincentives. It's the only thing that's going to work. We have to make it more profitable for individuals to cooperate and collaborate than to engage in adversarial behavior. Satoshi well understood this point, but so did almost everybody that came before Satoshi in the world of digital currency trying to build an online kind of money. Okay, but if decentralized systems have to be markets, then they have to exchange goods. There has to be a kind of trade of goods and services within that market. That's what markets are. Unfortunately, decentralized systems deeply struggle with traditional goods. They don't know how much money is in our checking account. They can't talk to payment providers. They don't know what real estate you own, because to know those things would require talking to, interfacing with centralized systems. That would no longer make the decentralized system decentralized. And so, in a sense, every form of asset or wealth that existed prior to Bitcoin is illegible, can't even be talked about, can't even be pointed at within a decentralized system. If we are going to build powerful decentralized systems, and if they must be markets, then there must be new decentralized goods, things that are legible directly within those systems. And historically, the very first such good that was conceived of was proof of work. A lot of people understand proof of work in this audience, I'm certain, but allow me to try to talk about it in simple terms. So remember, we're in a decentralized system, and proof of work was originally invented by Dworkin Naur in 1993 as a kind of access control mechanism. So there's a shared resource. They were often thinking about an email server, and I want this shared resource to have some metered, throttled usage, so I want to sell tickets to use the shared resource. But hey, I'm in a decentralized system. I can't use money, so you can't buy these tickets with money. You have to use something else. Let's use work. All right, so this is a little funny picture of, I think it's a Russian subway station, where instead of buying a ticket with rubles or whatever, you can just do some squats. Okay, that's kind of funny, gives you an idea of how it might work, but obviously these are online systems. We're not going to be doing physical exercise in order to purchase these tickets. We have to do some kind of online digital equivalent of work. So Dwork and Nauer suggest doing some math. Like they actually propose square roots. I've given a small example here of a factoring problem. It's hard to factor numbers, but it's easy to multiply them. So this is a kind of work that we can do in a digital system. But it turns out that's not exactly what you want. It takes Adam back a few years later when he implements Hashcash to build a hash-based system that implements proof of work. This is slightly better, right? If you know something about mathematics, you'll probably understand that factoring numbers is an arena in which cleverness is very useful. By being clever, you can more efficiently factor numbers. Now, efficiency and greater performance is usually called progress in the world. But for proof of work, that's not progress. That's exactly the opposite of what we want. We don't want you to do better because you're cleverer. We want you to do better because you did more work. And so we want a problem that can't be solved through increased cleverness. And proof of work provides an example of that problem. We also want it to be tunable. As you'll see here, we really want proof of work to be something that we can inject the concept of a price inside of. And that is important, right? Because I'm making the claim that decentralized systems are markets. So let's look at this market for email delivery that was proposed by Dwork and Nauer in 1993 and later actually implemented by Adam Back and Hashcash. It really is a market. Users pay email server providers in proofs of work for the ability to deliver emails. The user has an email, that's the data. They do some proofs, they do some work. They're guessing a bunch of random numbers, and eventually one of them meets the requirements of the math problem here, that is the proof of work. And the combination of the email and that winning number, the green one together, that's like the ticket. And then the email provider can verify that and send it along. So it's a market. But this is not how we actually solved the spam problem historically, right? We didn't do this. This is not how it works today. We do not use a market-based solution to spam because this is not a very good market. And that's because computations are not a very good form of currency. I can't take the proofs of work I receive as an email server provider and then pay someone else for some other thing with those same proofs. Hashcash, the proofs of work are tied at a moment in time. They've got an email address. They're not fungible. And so proofs of work aren't a kind of money. They don't solve the coincidence of wants problem. They are decentralized good. They are something that I can talk about in a decentralized system, but they're not money. So I need to make a new kind of decentralized good, something that is distinct from proof of work, perhaps related to it, but that actually has the monetary properties that I want. And this is hard, right? Because I'm still trying to build the first decentralized system over here, right? So somehow the market for this decentralized system must bootstrap the very currency it uses to perform settlement. This is a very hard problem. But in another way, it's trivial, it's easy. We know what the solution has to look like. I'm making the claim that decentralized systems are markets. There are two goods, proofs of work, and tokens of this new currency we're trying to build in this decentralized system. A market must exchange goods. We only have two goods. Ergo, the market must consist of the exchange of proofs of work for units of currency. There can be no other trade. The hard part is that this trade must do everything else the currency requires to exist. It must solve the problem of issuance. It must solve the problem of settlement. There must be a ledger somehow that is produced simply through doing this trade over and over. So let's look at some historical attempts to build this market. I'll start here with BitGold, I think first proposed by Szabo in, 1993, though not easily available till maybe a little bit later when he published it again on his blog in 2005. Nick writes, it's really hard to build a currency because computers get faster over time, and if you make an advance in computing, you can swamp the market, so to speak, with BitGold, these tokens that you're going to make in Szabo's version of a decentralized currency. And the thing about currency is we want all the units to have equal value, right? If there's a supply glut and there's some time period where because of increased proof of work, we're producing more tokens of BitGold, those tokens are just going to be worth less. There's a greater supply, so they should be worth less. How do we solve this problem? Like if the supply of proof of work changes, like how are we going to ensure that all the units of the tokens we're making from proof of work are actually worth the same? So there's a methodology that gets proposed here, which is think about cost, right? Like proofs should be timestamped. Now, this is not because of double spending or any of those. We'll get to those later. Proofs should be timestamped merely because a timestamp connects them to an economic climate and a certain market supply and demand of proofs of work. If you know, and Sabo says this very explicitly in his BitGold writings. If you know the time a proof of work was created, you can use that time to determine the average efficiency of computing hardware. And Dai says something very similar. Treat it like a commodity market basket of goods and try to determine from that what it must have cost to do that proof of work. And maybe that's a way to value it. And that's how you can perform this exchange in the market. But this is actually really hard to do, right? You're kind of running into that legibility problem. Decentralized systems deeply struggle with trying to determine how anything in the real world operates at all, much less the cost of computing. And so what winds up happening is that these BitGold tokens are not really a kind of money at all, because we can't really value them like within the system that we're creating them in. They're really kind of collectible. Szabo proposes that since, quote unquote, anybody can look at the supply of BitGold tokens, that a collection of outside the system so-called dealers will take the tokens that were made and they will bundle them into larger units of approximately equal value. And these larger bundles, these will be the money that we make. That's the idea here. So this is not as good of a solution, obviously, as Bitcoin. This is a format of making money after we've made tokens later on in what should be a decentralized way, but this is very hand-wavy and non-specific. It's not clear to actually implement this. What we want is we want that for the network itself to adjust the price of money directly, not some external system that happens afterwards, but the network itself. And Wei Dai in 1993 as well actually proposes kind of a model for how to do this. And I want to be clear that now I'm switching to B-Money, and in B-Money, Dai's already proposed the concept of using a blockchain, like that's already out there. Every participant should have a full history of all the transactions in the system. Those ideas are already present. Dai's talking now specifically about, hey, I think I know how to solve this. How do you value the computations problem? And I'm going to do it with an auction. So he proposes a 4-stage auction for how we can create the money supply and deal with the inherent supply volatility of proof of work. So phase 1 of this auction is planning. All the users get together and they talk and they figure out the optimal amount of money to create. I don't know what they're talking about because government agencies and whole departments and reams of economists, they can't seem to agree on the optimal amount of money to create. So I don't know how a bunch of nerds running software online are going to do the same thing. But in theory, they're supposed to publish macroeconomic calculations that support their bids. But even Dai admits they don't have to agree. They're unlikely to. What matters more is what happens in the next phase, bidding. Each user independently, this is important, each user independently puts out prices. I would like to create this many units of B-Money for this much work. And then someone else will put out a similar price or bid. I would like to create a different amount of B-Money for a different amount of work. So you have all the users in the system all putting in their own prices or bids for money creation. Now I've drawn 3 here, but you should think of this as millions of possible bids at any given moment in time for creating money within the B-Money system. And then phase 3 occurs. I don't know how phase 2 ended. It's not clear how we communicate to all the participants that we finished one phase and we're entering a new phase. That's a detail, a very important one that Dai does not address. But phase 3 is computation. Now that we have a bunch of these prices, these bids that have been submitted by the network, each individual user goes and works on their own bids. And in this case, you have the first user, they solved the proof of work that they bid on. The third user did the same. User number 2 didn't find a valid proof in the amount of time required. Maybe they bid too high and they couldn't do the amount of work. Maybe they just got unlucky. Regardless, multiple users are doing multiple amounts of work for different prices with different amounts of money being proposed to be created, and all the winning bids are broadcast to the network. In the 4th and final phase, the network actually creates money out of these proofs of work. And this is really tricky. The network demands that each user take the highest bids that actually had proof of work and then use those to define the creation of money and credit it to the account of the miner, if you like, who did the work. But this is a subtly very difficult thing to do. A decentralized system struggles with the concept of highest, because highest means we've taken a bunch of things and we've put them together in one place, and then we can sort them, and we can determine which ones are the highest. It requires us to have knowledge of all the elements of the set before we can determine its highest member. That's really, really hard. And not only that, but for many reasons that I tried to highlight, this system never works. For example, what if multiple users provide these multiple proofs of work and then different users get different bids that they see, right? Just because of the internet and variance and so on. Now, different users will have created different numbers of tokens. There's no mechanism that Dai suggests for how to fix this problem, right? Okay, so let's answer the question. How did Satoshi think of Bitcoin? So we all know that one of Satoshi's premier, most important #1 goals in launching Bitcoin was stopping inflation and stopping the dilution of the money supply. This is one of my, I think probably everybody's favorite quotes from Satoshi, like full of breaches of that trust, right? So for Satoshi, monetary goals were deeply important. And I want to highlight how new this is in the history of digital money. In BitGold, anybody can create BitGold by just doing proof of work. There's no monetary policy. There's no finite supply. The dealers will value large amounts of BitGold, times when there were large amounts of BitGold created, just less. And in B-money, there's similarly no limit. In fact, the users are supposed to, through their macroeconomic calculations and planning and bidding, figure out what is the optimal increase of money at any given moment of time. It can go on forever. For Satoshi, of course, the optimal increase in the money supply is eventually zero. This goal is fundamentally incompatible with granting users the freedom to create money. So Satoshi eliminated that freedom. It's the simplest decision. My conjecture, Satoshi read B-money, it's reference 1 in the white paper, and was like, this is pretty good, but I don't want these people to be creating money. I want to create the money. I want to have a finite supply. And my claim is that that thought was the key idea. Once you have that thought and that goal, and you decide, I want to take B-money, and I want to adapt the auction model so that users aren't creating the money, it's pre-created, and they're just auctioning off a finite supply. Once you have that idea, I think anybody could have discovered Bitcoin. Okay, maybe not anybody. Maybe you have to be really smart. Maybe you have to be one of the 10 nerds in the world at the time following these topics. But it's not as magical as it seems. I think it's a clear step from B-money through a finite monetary policy into Bitcoin. So let's see quickly in what looks like 9 minutes how this happens. How does this essential technical simplification emerge merely from the requirement that we should have a sound monetary policy? Well, let's start with phase 1 planning. In fact, we're going to find out that there are no phases anymore. We don't even need phases. That's one of the great parts of the simplification, because everything is just going to happen all at once. So phase 1, planning, this happened in 2008. Satoshi decided the monetary policy, and we all endorse it by running the software. That's it. There is no argument to be had between users. There's no multiple bids. It's done. Let's move on to phase, quote unquote, phase 2, bidding. This, I think, is the most important part of the simplification almost. In B-money, many millions of users are providing separate bids all the time, and the system somehow has to track all of those things and make choices like which ones are highest. Satoshi simplifies this. There's only one monetary policy, so there's only one bid. The entire network makes a deterministic calculation, which then results in a consensus price. And if you run a Bitcoin node, go ahead and run these 2 API calls. That's what you're really doing. You're participating in the deterministic calculation of the current market price for proof of work as offered by the entire network to the community of global miners. There's only one bid. Oftentimes, eliminating freedom reduces scope, and the reduction in scope allows something that could never have existed to actually be birthed. Let's talk about computation. There's no phase here. We don't have to wait for bidding to end because there's always just one consensus bid that all nodes are aware of, and they just perform proof of work continuously. The first one to discover a block at the current network price, of course, broadcasts it back to the network, but there's no phases here. And then money creation. Let's talk about this. We're no longer under an obligation that each user must somehow determine the highest bid or the highest proof of work. We know that all valid blocks are going to be at the network price. And so each user can merely accept the first block that they see. And this is the key idea that actually makes Nakamoto consensus possible. If users don't have to wait and make a local determination of an optimal choice, if they can instead follow a greedy algorithm and just choose the very first block that they see, this turns out to be a valid consensus algorithm. In fact, it turns out to be a breakthrough in consensus algorithms. Satoshi spends 25% of the white paper writing this calculation up, replete with C code, proving to you that Nakamoto consensus and picking the first block actually is a form of consensus and therefore ultimately solves the double spend problem. And this is incredible. All right, Satoshi made a progress in a computer science fundamental domain field. It wasn't Leslie Lamport, right? It was Satoshi. And it's because they weren't focused on a computer science problem. They were focused on a monetary problem, right? Like Bitcoin solves the double spend problem because of Nakamoto consensus. Nakamoto consensus works because it's a greedy algorithm that can be executed locally. Every user can just accept the first block they see. They can accept the first block they see because they know the block is only going to be transmitted if it's at the network price, and that's easy to validate. And the network price exists because Satoshi wanted there to be a sound monetary policy in which users aren't granted the freedom to create money. So it literally all comes back to eliminating that choice and then allowing the system to actually succeed. I really think that the lesson, if there is one from this, has to be that all 21 million Bitcoin already exist, right? And Satoshi, there's various ways you can maybe try to quote differently, but the way I read this quote is, Satoshi knows I can't issue coins. There's nobody to issue them. I have to issue them upfront, and then the best I can do is I can distribute them to the rest of the market over time. So the Bitcoin network is paying miners every 10 minutes in Bitcoin from an existing supply in order to perform proof of work, and the price is calculated deterministically, right? So all 21 million Bitcoin exist. Now, I think for a lot of people, if I had asked how did Satoshi think of Bitcoin, what's the key insight? The answer would have been, it's the difficulty adjustment algorithm. That's the most magical part of Bitcoin, I think, for a lot of people, myself included, prior to thinking about these things a bit more deeply. But I'm now of the opinion that the difficulty adjustment algorithm itself is something that you come to once you decide that you must have a finite money supply. Auctioning off Bitcoin's 21 million supply over 140 years is a very different sales proposition than doing it in 3 months after launch in 2009, because we didn't think about the temporal aspects of such an auction. No project before Bitcoin really framed the notion as, I want to restrict the rate in time at which money is created. It's not a problem in BitGold. If more money is created faster, we'll just devalue it later on with our dealers. And in B-money, if we are creating money too quickly, if our money creation periods are happening too quickly, our collective macroeconomic calculations should encourage us to increase the price and proof of work and fix that problem, but it's not really a problem. It is a problem if you are auctioning off an existing money supply. So one of the most natural things to jump to once you have this realization is, I need to fix the rate in time at which blocks are produced. And it turns out this is actually possible. You can measure through the blockchain what time blocks are coming in and use that as a basis to regulate the rate at which they continue to arrive in the future. So kind of reaching the conclusion here, and I have actually a couple more minutes than I thought. Maybe I'll actually finish this. Let's see. So just to summarize, right? Layer 0, I'm calling this layer 0 of the Bitcoin market, really just is a market exchanging proofs of work for coins of this new currency. And the network calculates a consensus price, the blocks must be time-stamped, and the current tranche of coins is always being sold. I've called this layer 0, though, and not Bitcoin, or layer 1 even. And that's because I think this market is logically prior to the usual market we think of in Bitcoin for transaction fees and settlement. In fact, I haven't even talked about transactions. And I think transactions are a totally separate market. They're a second layer, I'm calling it layer 1 here, that sits on top of Bitcoin's layer 0. So there's a single market in which, on the left-hand side in layer 0, users are exchanging proofs of work, miners are exchanging proofs of work with the entire Bitcoin network as their counterparty in that trade. That's for the purposes of distributing the initial supply of Bitcoin. There's a single consensus network price. In layer 1, users are directly trading with miners. There's not a single consensus price. There are millions of different prices. Those are the transaction fees that we include. The order book, if you want to think of it that way, in layer 0 is trivial. There is one price, and the very first block that shows up is matched. That's it. And layer 1, the order book is a little non-trivial, right? There's a mempool that has many megabytes of transactions waiting to be settled, right? It's non-zero, non-trivial. Of course, the settlement of transactions in layer 1 relies upon the existence of layer 0. The fact that blocks are in Nakamoto consensus, that they are time ordered, means that it solves the double spend problem. So layer 1 needs layer 0 to exist, but layer 0 doesn't really need layer 1 in some way. Anytime a miner mines a block with 0 transaction in it, they're engaging in a layer 0 trade, not a layer 1 trade. Oftentimes it happens together, but they can be separate. Of course, these markets are also tightly coupled, right? One of the cool things is that layer 1 works because layer 0 exists. Transactions are settled when they're put into the blockchain, right? So layer 1 needs layer 0 to exist. And to make sure that that connection is as secure as it needs to be, layer 0 winds up needing to understand the semantics of transactions in layer 1. The entire script language, for example, it only exists to enable us to write more complicated transactions in layer 1. Script is not necessary at layer 0. All we're doing at layer 0 is just giving Bitcoin to the miner that won the block. That's it. There's no more complexity than that. Now, of course, a network that does not allow its users to trade the coins that they've earned through mining wouldn't be a very useful network. So layer 1 has to exist just to increase the value of layer 0. And I think this is really the pattern that I want us to emphasize, like going forward with Bitcoin, that it's a system of layers of markets, and the lower layers provide functionality and solve problems for the higher layers. The higher layers add value to those lower layers and actually make them more interesting long term. So as we think about how Bitcoin grows, the plan is to build more and more and more markets so we can solve more and more problems, but yet do it in such a way that we're creating the right layering and the right sense of coupling between these various systems. So maybe next time I can give you guys that talk. Thank you.